Case study of the Indian banking and financial services industry using strategic tools. Finance is like oil to the engine of the Indian economy. As finance is the grease and the oil that keeps the engine of any economy running, the BFSI sector assumed importance in this context. While the post-independence era witnessed many large private banks that were either family or community-run as well as some government-owned banks, the nationalization of the banking sector in 1969 and the early 1970s mean that the government was the prime mover as far as banking and finance was concerned. The situation of government ownership of banks continued well into the 1990s when the first wave of liberalization ensured that banks were now allowed to be privately owned. While multinational banks were always privately owned, most Indian banks were government owned or owned in a quasi-governmental manner. Even after liberalization, the RBI or the Reserve Bank of India proceeded cautiously as far as private ownership of the BFSI sector was concerned. However, this didn't deter many firms such as the NBFC or the non-banking financial companies from operating and indeed floating the rules, thereby leading to periodic bouts of crisis. Becoming world-class in their practices and dealing with crisis. Now, the BFSI sector in India is in a position where it can compete with its peer abroad and elsewhere mainly due to the pioneering efforts of the first wave of post-liberalization banks such as HDFC and ICICI. No wonder that the Indian BFSI sector has become a dream job destination for millions of graduates in the technical and managerial institutes. Having said that, at present, the BFSI sector in India is in crisis due to its profligate lending practices during the boom years of the first decade of the 21st century. Indeed, concomitant with the growth of the Indian economy and the blistering pace of capacity addition as well as booming industries, the banks and financial institutions threw caution to the winds and engaged in indiscriminate lending without doing their due diligence. For instance, during the heyday of growth between 2000 and 2008, banks and financial institutions in India lent to just about anybody, and the GFC or the global financial crisis of 2008 resulted in such debt turning back. However, it is to the credit of then rolling dispensation that the 2008 crisis and the global bust didn't have major impacts on the Indian BFSI sector due to adequate oversight and regulation by the government in tandem with the RBI. Having said that, some experts believe that what they did was to merely kick the can down the road without solving the problem, and this in turn led to the ballooning of the NPAs or the non-performing asset to such an extent that at the moment, absent massive recapitalization, the Indian BFSI sector would be in major trouble soon. Pastel analysis. Political. In India, like in most developing countries, politics is inseparable from business, and hence the Indian BFSI sector is indeed impacted heavily by the policies and the regulation that are posed by rolling dispensation at the center. Moreover, given the high incidence of governmental and public sector ownership of the so-called state-run banks, political interference is natural and a major input into the decision-making process at the banks. While experts have repeatedly called for lesser political interference in the running of the bank, most people agree that it is routine for lenders in the public sector and even the private sector to pay heed to requests from politicians as far as lending and other aspects are concerned. Thank you.